business automobile and how tax depreciation rule works in the business automobile deduction. And before we go on there, let's just brag about ourselves a little bit. And this is our website, folks, communitycpa.com. And on the website, you can see what's new. And you also can actually make appointment with us right here, right? If I can find my mouse. Right here. This is where you can make appointment. If you click on here, and then, oops, what did I do? If you click on the appointment, it will show the partners here for you. And you can see where the partner is and what they're specialized, and then you can book their time, right? You can see me there as a CEO of a managing partner. Then with the website, you can also, our website link into our YouTube channel, but you can also come to YouTube to check us out. I have a hard time to manage my mouse today. I cannot really make it work. Let's see. There you go. That's a YouTube channel. And you can subscribe to our YouTube. We have all of our webinars after we talk, and we put them on YouTube channel. So you have that knowledge right there with you. So if you cannot participate at 3 p.m., of course, you can come to participate during that time. And now let's get into our discussion related to this topic we are going to focus on today. And that is the business automobiles, how the tax depreciation rule work. All right. So first of all, and this is our, this is our routine every time. When I get online, we see new people coming to us. So we want you to get to know me. And my name is Ying. I am the managing partner and the CEO for Community CPA. And I started Community CPA back in 1998. Not too long ago, right? It's just a couple years older than when you were born. But yes, I started in 1998. And we right now has more than 10,000 clients and about 40 professional people in 4 different states. And I also an author of this book called Appointment with Ying at 8 a.m. And this book, for the reason to be at 8 a.m. is to start your business, how to start a business. That's the book about 8 a.m. I finished, just published this book last week. And this one is growing your business, right? 10 a.m. We expect you to start in 2 hours time and get to grow, right? So, but this book is all about how to grow your business based on our clients' experience and our own as well. So you can go on Amazon to find our second book that is now available. No responsibility disclaimer, just as usual. And this is really what we're providing you to have you do well, taking your business matter into your own hand. The more knowledge you have, the better decision you're going to make along the way. You know, there is no such thing about people just got lucky and they got successful. And it is really about how you engage yourself, how much you learn, how much you know about your own business. That's how you grow, right? All right. With that said, let's dive in. What is depreciation? Depreciation is an accounting adjustment. It's not a real expense. It's accounting adjustment that you make to your asset. So for talking about automobile, immediately you think about mileage deduction. You were like, oh yes, I know. And I can get 1 mile for 65.5 cents per mile driven. That can be my reimbursement. Obviously, that 65.5 cents is a recommendation from IRS. IRS uses that one for their reimbursement. Other businesses also use that one to reimburse their employees. Every company have their own rules, so you don't have to be 65.5 But if you want to reimburse more, IRS says no, that is the maximum you can do. So depreciation for your vehicles is built into the standard mileage rate already. So if you are claiming standard mileage rate for your reimbursement, for example, you drove 5 miles, 10 miles for your employer, and your employer have you submit travel reimbursement. So you take the 10 miles times, if 65.5 is your rate, some employer will have it 20 cents, 30 cents, 40 cents, anywhere. The state government normally do around 30 some cents. So it is a fixed rate that you're getting from your employer. You times that. So the maximum you get is $6.55. So that is a standard mileage reimbursement rate, reimbursement you're getting. Separate depreciation calculations for a passenger vehicle only comes to play when you choose to use actual expense method to calculate deduction. You may be sitting here goes, Ying, I don't know what is the actual difference versus mileage, and we actually have a webinar for that. So if you go to our YouTube channel, type into mileage deduction or vehicle mileage deduction, and you will pull out all the webinar related to that. We have one specifically talking about the difference between actual and mileage deduction. So actual expense method, it is the one that would use depreciation. So we want to make sure that you know right here, right now, when you do standard rate reimbursement, you already are counting on depreciation. Your 65.5 cents in there has depreciation components already. So only the actual reimbursement, the actual expense method would have these kind of things coming into play. So actual expense method, depreciation calculation. So let's talk about that. If you use actual expense method for passenger vehicle deduction, you must take separate deduction, separate depreciation calculation for each year until the vehicle is fully depreciated. Fully depreciated just means that whatever price you have your vehicle, say total 100,000, totally depreciated just means that it went down to zero. So you no longer has values on that vehicle by your book because you will taking depreciation out every year until it equals to 100,000. According to the general rule, this is a general rule. Year 1, you depreciate 20%. Year 2, 32%. Year 3, 19.2%. This is the percentage that as a general rule. And the different rule applies if the vehicle is used less than 50% for a business. So you know how when you go to the actual expenses, one of the question for you is that whether you use that car 100% for business or what percentage would that be for business use, you need to put in there. But if you put in 60%, 70%, as long as it's more than 50%, your depreciation first year is 20% of the value of the vehicle. The second year is a 32% of the leftover value of the vehicle. The third year is 19.2% of value of the leftover vehicle. So that is kind of how, generally speaking, depreciation calculation goes like that. You may say that, well, no, Ying, how am I going to remember that? Don't need to remember that, folks. When you are using your TurboTax to calculate your business vehicle use, as long as it's actual method, and when you put in the value, your system, your TurboTax actually helps you to keep track of that. But of course, you don't want to rebook your vehicles every year, right? Otherwise, the system thinks it's 20%, and again 20%. You want to keep your vehicle in there as a second year, third year, so it can go smoothly based on the chart, right? And depreciation does have ceiling. So for passenger autos exceeding certain costs, their actual depreciation ceilings just means that you can't just like, okay, what if I bought a $200,000 vehicle? 20% first year, that means I can deduct $40,000. No, the vehicle maximum amount is 20,200 the first year. If special depreciation rule is in act, then you would claim more. So generally speaking, you want to remember that there is a ceiling. So you don't want to go over. You can buy a very expensive vehicle, but you cannot go over that 20,200. For passenger vehicle placed in service in 2023, so this year I'm talking about. I assume you finished all your taxes yesterday, so now the topic should not be 2022 anymore, it should be 2023, right? The maximum luxury vehicle depreciation deductions are year 1, 20,200 if bonus depreciation is claimed. Then 12,200 if bonus depreciation isn't claimed. So what is bonus depreciation? Bonus depreciation is a rule that enacted by Job Act. So basically, you can depreciate your vehicle faster than normal, right? And then year 2, you have 19,500 ceiling, and year 3, you have 11,700 ceiling. Then you go for year 4 and after is 6,960. So this is where when we think about automobiles depreciation, and do not think like your leasehold improvement. If you renovated a place for $350,000 and your bonus depreciation come through, everything can be written off in 2022. 80% of it will be written off in 2023, but vehicle has a ceiling, 20,200. Depreciation and the non-business use. These ceilings are proportionally reduced for any non-business use. So for example, the 20,200 is the ceiling, but what if you use the vehicles only 60%? Then it will be 60% proportionally reduced, right? So if a vehicle is used for 50% or less, for business purpose, you must use straight line method to calculate depreciation. So you don't have any other ways to do it. It's a straight line. If it is 5 years, you divide it by 5, 10 divided by 10. So that's what you need to do with your less than 50% of use for business. All right. So the Tax Cut and Job Act, this is the one I was mentioning where the bonus depreciation got created. Then it talks about by the time we reach 2027, it will slowly go down. In 2022 was 100% eligible property you can write off. So a good example would be the renovation. If you renovated your retail store for $350,000, say 300, and then in 2022 you write off the total amount. But in 2023, if you did the same thing, you would only write off 80%. So if you are going to renovate something next year, we are already at the end of 2023, folks. You better hurry up, right? But if you already did that in 2024, you already planned that to happen in 2024, then it is only 60% that can be written off. To claim first year bonus depreciation for a used vehicle, it must be new to the taxpayer. So the first year bonus depreciation claim is not limited to a new car. So you could get an old new car. So as long as it's new to you, right? So that is what you want to remember. So a lot of times, and people will say that it has to be brand new. No, it is new to you, and that's good enough. So I just want to, make a point on that one. And from time to time you hear people talking about that. Oh, my car is over 6,000 pounds. That make me having better deduction. And the answer is yes. So heavy SUV and the pickup and the van, generally speaking, has a better depreciation route. And let me explain that to you. So if bonus depreciation is one thing. We talked about that. and it's phasing out to 2027, right? So by the time we reach 2027, we're kind of done with that. And unless Congress pass new law and to put it back, otherwise the benefit is gone. But Section 179 tax deduction, that is a very old tax deduction, and that is still there, still standing. So the difference between 179 versus bonus, so let's say if your business didn't make money, and when you do bonus depreciation, you created $100,000 loss, right? So you would take the loss and offset your income, you actually get a lot of tax refund back. But that 179 tax deduction doesn't work if you don't make money. So it's only reduce your profit. It doesn't allow you to have a loss triggered by 179 deduction. So with that said, 179 are really the business making a lot of money, going to pay a lot of taxes. Then they use 179 to reduce their taxable income to pay less taxes. But not for the company who is already at a loss. And I mean, the company is already at a loss, but they're just wanting to pass on that loss to your 1040 because, our spouse makes a huge salary, big W-2, so maybe that can offset and get some tax benefit, right? So 179 has a characteristic that helping the one that makes a lot of money. And the favorable depreciation rules apply to heavy vehicles, and which is certainly used for the vehicle must be used for business mainly. So you cannot be like having a pickup truck, but it is less than 50% of business use. Then you go straight back to either claim mileage or you do actual, but it's straight line, right? So that's what we talked about. They're treated as a transportation equipment for depreciation purposes. That's why they have a favorable depreciation treatment. They are not treated like a normal passenger vehicle. They are like a tool. They're like an equipment. That's why they have a better depreciation treatment. A gross vehicle weight rate is called a GVWR, in short. If it is over 6,000 pounds, and you will have the legitimacy of deducting the way we're talking about here, and to really identify whether your vehicle is that way or not, it is actually on your driver's side door. You can find that, and that term GVWR will be there, and it will tell you whether that's above 6,000 pounds or not. So if it is above, then you can treat that as a transportation vehicle equipment. Then you can do Section 179 deduction. You will do bonus deduction if that's available. So you are basically depreciating that as an equipment. So that is where depreciation comes in related to your vehicle, folks. So once your vehicle is becoming depreciated equipment for your business, you can imagine that one thing you need to take a note. You want to make sure that equipment, that transportation equipment, that vehicle's title is under your company's name. Normally, what I would advise our client is that if you are buying a vehicle for your company, you put your personal name on there too. Not just the title to the company, but also title to yourself. So two of the entities are on one vehicle. And what will help you is, in case you get into financing, the dealership would willing to finance that under your name, under a person's name. And in case you need to get an insurance, and the insurance agency can insure that car under your name, because obviously you're not sharing with the rest of your employees. This is your car and you're driving it, so risk is that way. So they are able to give you more favorable insurance. So having your name on the vehicle also company name on the vehicle would help you to get cheaper insurance, would help you to get financing easier. And at the same time, when you get audited, IRS comes around, goes, why do you think this is a business vehicle? Of course it is, because it's titled under the business, it's 100% for business. But what if you use it for personal drive? The correct thing to do is to reimburse your company of your personal mileage. So if your company reimbursing you 20 cents per mile for driving personal vehicle for a business reason, then you want to reimburse the company of that. Just same old, right? Vice versa. So you want to make that arm's length treatment for you using company vehicle, driving your kids to Chicago or somewhere, right? So with that said, that concludes our today's 30 minutes with vehicles related to depreciation. I hope you learned one thing or two, and I am so happy to see you again here. I see a couple of you are, familiar addresses that I see before. And you can email Catherine at communitycpa.com, folks. And this is where you can tell us what you want to learn from our webinars. And you can call us on this 515-288-3188 number. We are open 6 days a week, Monday to Saturday. And our YouTube channel is Community CPA channel name. Go on to our YouTube channel, subscribe to our channel. And if you like our videos, give us thumbs up. That is how we get encouraged, keep on going and bringing more useful knowledge for your everyday boring business life. No, it's not boring. Business life is exciting, right? All right, I'll see you again on Saturday and see you excited, ready to move forward and ready to come to Community CPA to get your tax planning done this year. Yes, tax planning for the year end. All right, bye-bye.